Hello and welcome back to another stock analysis on Stock Market Palantir. Make sure to subscribe and let us know your thoughts in the comments. Now, let's hear from our analysts.
We're diving right in today to one of the most transformative economic forces I think we're seeing emerge right now. It's this collision between global decarbonization mandates and the truly insatiable energy demands of artificial intelligence. And this has created a kind of macroeconomic supercycle that demands firm 24/7 baseload power.
And sitting squarely, right at the nexus of that demand, is NuScale Power Corporation, ticker SMR. This company is in a singular, almost contradictory position. On one hand, they are the only small modular reactor developer in the West that actually holds a standard design approval, the SDA, from the U.S. Nuclear Regulatory Commission. So you have this huge technical validation running headlong into, frankly, profound commercial skepticism.
Yeah, and that tension makes the stock a real high beta battleground. It's trading right now at a critical point, around, $18 a share. That gives it a market cap of about $4.1 billion. But you have to look at the technicals. The daily volume often shoots past 20 million shares, and the short interest is just staggering. It's routinely north of 25% of the float. That level of polarization tells you the experts are just radically split.
Oh, it certainly suggests that. It suggests that a significant and I would argue very sophisticated portion of the market is betting heavily that the company just cannot convert that technical success into commercial viability.
Well, today, I'm going to argue for the viability of that aggressive, call it 5x upside potential. And I don't think this is just speculative. It's fundamentally driven by the enormous, urgent demand shock that's coming from the AI energy nexus. We are talking about a projected 176 gigawatt market for data center power alone by 2035. NuScale is positioned, I believe, to capture a really disproportionate share of that.
And I'm going to focus on the severe execution risk profile and, the structural liquidity constraints that frankly make that upside a very long-shot outcome. I believe the near-term downside risk is far more immediate and concrete than any clear path to 5x returns.
So let me start by just establishing the competitive foundation here, the regulatory moat. The standard design approval that NuScale holds is not just some stamp of approval. It is a formidable market-defining asset. In the nuclear world, the regulatory process it's usually the single biggest barrier to entry and the greatest source of cost overruns. The STA is, in essence, a pre-approval of the reactor's core safety design.
So what does that actually mean for a customer, in practical terms?
It means that every subsequent customer who's seeking a combined license, which is the final step before you can pour concrete, they don't have to spend years or hundreds of millions of dollars reproving to the NRC that the core design is safe. That argument is effectively frozen. This shaves years off the licensing timeline and gives NuScale a clear, unassailable 3 to 5 year commercial window against every single major competitor. They basically won the regulatory lottery.
Okay, I acknowledge the significance of the SDA, I do, but a regulatory head start is pretty meaningless if the unit economics are fatally flawed. And that, I think, brings us to the core problem. The speed of approval doesn't solve the price of the power.
But let's look at the customer. The hyperscale data center market, it requires 24/7 power that intermittent renewables just can't supply. Not without storage solutions that are prohibitively expensive and logistically just a nightmare. NuScale's Voyager 12 plant at 924 megawatts electric has what I call the Goldilocks sizing. It's a huge amount of reliable power, but, and this is crucial, its modularity allows customers to ramp capacity alongside their capital expenditure. You can buy 2 modules now and 4 more in 3 years. You're aligning power needs precisely with your data center expansion.
That all assumes the power is affordable. I see the technical iteration. They're moving the module up to 77 megawatts to improve the target levelized cost of electricity, the LCOE. But I just don't buy that the improved economics work yet, not given their history.
You're referencing the UAMPS project, I assume.
Precisely. Let's talk about commercial fragility. The ghost of the carbon-free power project, the CFPP, proves my point. That was their flagship project, intended as the first commercial deployment, and it collapsed. It collapsed because the target price for power rose from a competitive, $58 per megawatt hour to nearly 89. That 50% price jump fundamentally highlights this crippling, first-of-a-kind, or folk cost barrier.
That project involved the consortium of regional utilities, which are inherently more risk-averse and financially constrained than the trillion-dollar hyperscalers we are talking about now. And on top of that, that price escalation was largely driven by factors outside the core technology, like inflation and supply chain bottlenecks that were unique to that period.
Regardless of the cause, the cost escalation demonstrates the massive difficulty in achieving unit economics at scale, and it drove away their customer base. Now you layer that technical challenge with the financial reality. The company is defined by cash burn. Right now, it's estimated to be between $100 and $150 million annually, just to keep the lights on and the design work flowing.
Well, they're still a development stage company. That burn rate is to be expected.
But with only $400 to $500 million in cash on the balance sheet, their runway is extremely short, maybe 2 to 3 years at most, barring any real revenue. This necessitates constant, programmed, and very dilutive at-the-market or ATM equity offerings.
Could you just elaborate on the impact of that ATM program for our listeners?
It's highly damaging to sustained price discovery. An ATM program is not a one-time stock sale. It's a persistent, programmatic way to fund operations by continuously selling little tranches of stock directly into the open market. This creates a perpetual supply wall. It suppresses the stock price and it crushes any potential rally before it can gain momentum. This structural suppression is exactly why the short interest is so high. The smart money sees a company that has to constantly eat its own equity just to survive until a big contract materializes.
Okay, this brings us to the core tension then. Do the commercial agreements in the pipeline actually alleviate this liquidity risk? We need to look critically at that backlog, because it's really the only way to resolve the binary outcome for this company.
I agree. And this is where the execution risk is most apparent. I want to challenge the legitimacy of their most prominent deal, the partnership with ENTRA1 Energy. Research by Iceberg has characterized ENTRA1 as, essentially, a shell company with no employees, no visible assets. The concern is that NewScale is effectively vendor financing its own customer.
Explain what you mean by vendor financing in this context.
NewScale is paying ENTRA1 large sums, around $495 million, for what they call development work. Now, if the technology provider has to pay nearly $500 million to its supposed customer just to develop the project, it suggests the customer is not commercially viable on its own. And it suggests the backlog is more illusory than a real, firm order backed by independent funding. It looks like a desperate measure to generate a press release, not a real commercial breakthrough.
That's a compelling argument, but I think it fundamentally misunderstands the context of massive infrastructure development and the role these financial conduits play. NewScale defines ENTRA1 as an exclusive global strategic partner. It's backed by the Habish Group, a very powerful player in energy finance. In this developer-led model, it is absolutely common for the technology provider to fund early development work, the feed studies, site characterization, to sort of prime the pump.
To de-risk the project for whom?
To de-risk it for the ultimate utility buyer, or more likely, the large data center operator who will eventually sign the power purchase agreement. The fact that the Tennessee Valley Authority, TVA, a federally owned corporation with exceptionally rigorous procurement standards, signed a massive framework agreement to deploy up to 6 gigawatts of NewScale capacity with ENTRA1, that's the validation you need.
That's an interesting point, though I would frame it very differently. TVA's involvement certainly suggests that ENTR81 is not purely fictitious. I'll grant you that. However, we have to be precise with the language here. It is a framework agreement. It is not a definitive, binding, funded purchase order. The TVA agreement is an option. It's the intent to potentially use NewScale's technology. It is not the check in the bank account that alleviates that near-term cash burn pressure. And that distinction is absolutely critical to the short thesis.
I agree, the distinction is critical, but the fact that a utility like TVA is willing to commit to 6 gigawatts in principle suggests that the technology and the platform delivering it has passed some very stringent governmental due diligence. That provides enormous non-monetary credibility.
Credibility doesn't pay for fuel, though, and we have to return to those immediate capital constraints. We haven't fully addressed the elephant in the room, the Fluor Corporation divestment overhang. This creates an imminent structural liquidity constraint that puts a firm ceiling on the stock price.
We both agree it's a crucial structural constraint, yeah.
Fluor Corporation, the original parent, the current massive shareholder, has agreed to divest its entire substantial stake by the second quarter of 2026. Knowing that a major holder is committed to selling tens of millions of shares over the next 2 years creates this persistent supply wall. Every single time the stock attempts a breakout rally, maybe driven by some positive news, that wall of future supply just looms there. It suppresses the price and gives short sellers confidence that the float will just continue to expand at a suppressed valuation.
I see why you think that's a bearish headwind, but let me give you a different perspective. This divestment, while creating near-term friction, is actually a powerful long-term bullish catalyst. Once Fluor is completely out and we have a clear timeline for that exit, the overhang is removed entirely. That improves the free float, which increases the company's eligibility for major index weighting and broader institutional ownership.
But the selling pressure lasts for 2 years. That's a long time.
But crucially, the completion date in mid-2026 aligns perfectly with the expected timelines for major firm commercial orders, specifically the RoPower final investment decision in Romania. If that happens, the stock sees a powerful double catalyst event. The structural constraint of the overhang is lifted just as the fundamental commercial success arrives. That transition creates the perfect storm for a significant repricing of the stock.
That requires perfect execution over the next 2 years, and the history of nuclear development does not suggest perfection. And this brings us right back to technical advantage versus the ultimate execution risk on the ground.
We have to reiterate NuScale's core technical lead, because it directly mitigates some of that execution risk. The Voyager plan's passive safety features they're game-changing. They allow the plan to be walk-away safe for 30 days without any operator intervention or additional water pumping. This changes the entire risk calculus.
The passive safety is certainly an elegant technical marvel. I grant you that. It does simplify the design.
The practical benefit is profound. It allows for a drastically reduced emergency planning zone that is crucial for siting a large power plant near urban or industrial areas like these hyperscale data center campuses. Furthermore, we have to look at the fuel supply. NuScale uses standard low-enriched uranium fuel, or LEU, which has a robust, mature, existing global supply chain. This is a massive de-risking factor.
And why is that supply chain so critical?
Because it avoids the massive, almost existential execution risk faced by competitors like Oklo, which relies on high-assay low-enriched uranium, HLU. HLU is essentially a higher-grade, near-weapons-grade fuel, and right now, the infrastructure to enrich and produce HLU at commercial scale in the West is, well, it's functionally non-existent. NuScale's choice of LEU avoids building an entire supply chain from scratch. That dramatically reduces its technical execution risk.
It minimizes technical risk, yes, but the commercial risk remains paramount. The technical promise is immaterial if the company fails to execute the physical construction phase. Moving from a validated digital design to physical concrete construction is just fraught with peril. The entire industry is notorious for massive cost overruns. I mean, look at the decades-long debacles at Vogel or Olkiluoto.
But those were gigawatt-scale custom designs, not standardized factory-built modular units.
The modularity thesis has yet to be proven in practice. If that first Voyager plant, whether it's RoPower or wherever it lands, goes significantly over budget, the entire economics of scale narrative dies immediately, and the economic model collapses. This is the heart of the existential risk. If they miss on that first build, the stock, which is trading around $18 now, could truly approach zero. The sophisticated short thesis isn't betting against the STA, it is betting on that FOAK execution failure.
And that's why we return to the demand side. The commercial calculus has been inverted by AI. The cost of not having reliable, scalable, 24/7 power for a hyperscaler whose revenue is tied to exponential AI training, that cost is now immense. And it may very well outweigh the cost overruns of a reliable baseload nuclear source. The pressure to secure firm power trumps the desire for the lowest possible price.
I agree the urgency is unprecedented, but the balance sheet remains unforgiving. To summarize my position, the fundamental risk is still commercial fragility and these structural liquidity constraints. While the SDA is a powerful regulatory advantage, the stock's future hinges entirely on converting soft agreements like that TVA framework into a definitive, binding, and fully funded purchase order for a gigawatt-scale deployment, preferably for a data center, and within the next 12 to 18 months. Without that firm revenue visibility, the ongoing pressure from perpetual dilution via the ATM program and the huge entrenched short interest will likely continue to dominate and suppress any price action.
And my summary focuses on timing, leverage, and the inevitability of this demand shock. NuScale possesses a singular non-replicable regulatory advantage that is perfectly timed to meet this urgent and massive demand pull from the AI sector. The current $4.1 billion valuation, it just doesn't reflect the potential leverage inherent in its pipeline of 6 gigawatts plus. So if the supercycle scenario materializes, and that means successful execution on raw power, and crucially, converting a TVA or hyperscaler deal into a signed contract, the combination of that execution success and the massive short position could trigger a violent repricing event. And that would drive the stock well beyond the suggested $60 targets, delivering that promised 5x return.
It remains an investment that you have to treat as a high-risk venture capital asset. The binary tension between that massive multi-bagger upside potential and the severe immediate execution failure risk, it's completely unresolved. The final verdict is truly left to the marketplace.
Thank you for illuminating both sides of this remarkable tension.
If you enjoyed this video, subscribe to the Stock Market Palantir channel for more stock reviews like this. Thanks for watching, and see you next video.